Thanks for waiting. One of our advisors will be with you as soon as possible.
Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Robert Salter and Gabby Donald.
Welcome to The Tax Factor, the UK's top tax podcast. I'm Robert Salter.
And I'm Gabby Donald.
We thought we'd start the podcast acknowledging the inauguration of President Donald Trump for the second time, but the producer said that the music rights for Clip of the Village People would blow the budget, so we haven't done that. However, whilst President Trump has been signing countless executive orders in the US, perhaps the biggest position or issue from a tax perspective is closer to home, and it's a story we've been covering regularly since the start, specifically in terms of how US policy will link into the OECD BEPS arrangements and the global tax position. Gabby?
Yeah, so the potential nasty surprise here, I think, is obviously a lot of countries have been adopting the OECD's 15% minimum tax, but Donald Trump has signed an executive order that effectively has the impact of introducing the ability for the US authorities to impose effectively an additional taxation where they consider other countries to have imposed discriminatory foreign taxes on US companies and individuals. When you look at that in the context of the 15% minimum tax, that could certainly have an impact. When you look at the difference between a sort of 10% rate that a lot of US companies pay in the United States versus that 15% minimum.
Yes, it's going to be a bit of a hot potato because obviously there's an issue as to whether the global minimum tax will really work without the American agreement, because let's be honest, economically, America and American firms are very dominant. Clearly, at the moment, you potentially got a position in America where the American legislation will say a global American firm, Apple or something like that, will only have in effect a max, well, kind of a give or take 10% tax rate, whilst clearly then under the proposal from the OECD, other countries can try and make that up and say, well, you've only paid 10% globally, we want a higher percentage in Ireland or France or wherever that is. Now, that will obviously be controversial from an American perspective. It won't play well with Trump's base. And certainly the suggestions already that he's asking the IRS to look at the kind of implications of that and see what kind of options he would have to make sure that that doesn't happen, or in effect do everything he can to minimize the chance of that happening. So there's issues about, for example, whether he can argue that's discriminatory in accordance with double tax agreements and everything like that. And there's certainly something within the IRS kind of legislation, something known as the subsection 891 legislation, which basically allows Trump to impose punitive taxes up to 80% without kind of any wider approval from the Senate or Congress or anything like that. He can just impose those. So it's certainly something which could be nasty. It could certainly undermine the whole proposal to have a global minimum tax band. So you may find like countries like Ireland, which have gone up to the 15%, but kind of unwillingly in a way, will love it. But it creates uncertainty. And I think uncertainty actually for most companies is not a good thing. It's not a good thing for revenue authorities. It's not a good thing for governments. And I don't know where it's going to lead. So that's kind of an area of concern, I would say.
Yeah, I think that's absolutely right, Robert. And I think when you talk about uncertainty, you've really hit the nail on the head there. I mean, particularly when you look at, as you say, Section 891 gives the president the powers himself. And in an environment where the importance of him playing to his base is so fundamental to him politically, you could conceivably see a situation where he chooses to enact those powers, particularly given that there is no congressional break on him.
And it'll be interesting to see how it applies on a country-by-country basis, because again, I can easily see it being something where he will, in effect, almost reward his international friends, to the extent he has any, but punish anybody who's slightly critical of him, which, you know, isn't healthy from any political debate perspective, but he doesn't seem to worry about kind of wider messaging or the wider position. It's all about short-term gratification, I think, in many cases. So, like I say, it's an area of concern, I think, for a lot of people.
Definitely a space to watch.
Okay, well, that's enough about Donald Trump, although I'm sure we'll come back to him again in the future. Gabby, do you want to talk about the recent Public Accounts Committee report into HMRC and the performance of HMRC?
Again, I feel that this is a theme that we've been talking about for a very long time and will no doubt continue to talk about a great deal in the future as well. The background to this: the Public Accounts Committee recently issued a report into HMRC service levels and the impact on taxpayers. And it's focused, I guess, primarily on three areas: HMRC's telephony services, HMRC's digitalisation strategy, and lastly, HMRC's ability to collect debt effectively and to close the tax gap. And the report found a few interesting points that I guess doesn't surprise us and probably won't surprise a lot of people. The MPs in the Public Accounts Committee noted that average waiting times for HMRC's telephone services are in excess of 23 minutes. And that's the good news, because 44,000 customers were unfortunately cut off altogether with no callback after waiting more than 70 minutes, which is an incredibly long amount of time to sit waiting for your call to be answered on a tax issue that presumably is something that is concerning you and you need an answer to. And the other point that I think the committee highlighted in respect of HMRC's telephony services is that HMRC does not give enough consideration to the needs of customers when it considers its phone services. And I think this was highlighted earlier this year when HMRC actually issued an announcement stating that they were going to turn off their telephone services and their helpline, and then swiftly had to backtrack on that within about, I think it was roughly 24 or 48 hours. When we look at digitalisation, the report also finds a number of interesting things. It highlights the need to actually support customers properly now. So we're aware that obviously HMRC has a digitalisation strategy and wants to become a much more technology-enabled tax authority. But obviously in its move towards digital services, it mustn't forget that customers need to be able to properly access services now. And sometimes what we find with digital services is that in the switchover or in the implementation of new systems, there can be challenges for taxpayers in accessing the services that they actually need. Another point to bear in mind in this context that the report highlights is that HMRC's own estimates are that there are approximately 7 million taxpayers in the country who are digitally excluded, so aren't actually able to use effectively HMRC's online services.
Yeah, I think it's the sort of thing where the Public Accounts Committee has criticised HMRC for a number of years. The National Audit Office has criticised HMRC for a number of years. And, I genuinely feel that in many respects, HMRC has done nothing about it. Now, how much of that is the fault of HMRC and how much of that is a wider issue about the correct funding and, the guidance from Treasury and the position of, the politicians have taken? I think a lot of it is outside the control of HMRC, but it just shows you how poor things are. And you have to hope that we're going to have some improvement as we go forward. I'm not convinced we will have, certainly not in any quick, noticeable basis. I think it's going to be quite a long-term thing. Talking about it from a strategic perspective, I genuinely do think that HMRC has, and some of this was picked up by the PAC, genuinely has the long ideas and long focuses. It focuses very much on simple, easy wins, which aren't significant in many cases, whilst ignoring much bigger issues, which are in the too difficult camp and therefore try and ignore. Easy examples of that are, and this is, the PAC said this, they'll focus on, obviously speaking, the £50 tax debt, which may be a slight cash flow issue or mistake on the part of the individual, and then they'll ignore the company that may owe them £1 million or £2 million, because that's quite difficult to get. So that's not really useful. Similarly, we know there's an issue with offshore tax avoidance promoters or evasion fraud promoters, call them what you want. But again, they don't really seem to target that at the end of the day. If they are, it's very well hidden. And again, it's in the very difficult camp. I don't think anybody would ever question it's in the very difficult camp. But some of the policies and processes are having going forward about, for example, the way legitimate accountants, tax advisors, etc., are governed and kind of overseen by, HMRC. Relatively insignificant issues. The legitimate accountants, the legitimate advisors are not the problem when it comes to dodgy schemes or anything like that. But that's who they're focusing on, not the actual enablers and promoters of such schemes. Like I say, it actually leaves innocent, naive taxpayers who often get caught out by these things losing. And they are the ones who will get forced to have the big payments and things like that, perhaps sell the home in extreme cases or whatever.
Yeah, and I mean, that's often been the problem, hasn't it, Robert, that they've focused too much on introducing additional regulation and additional provisions to target those who are already doing their best to be compliant, that won't actually help them capture those actually genuinely non-compliant taxpayers and agents.
Yeah, there's no focus on really how do you attack the cowboys and going after the cowboys. And I'm sure it can be done. It'll be interesting to see how other countries do it, if they're more effective. But clearly there's a gap there, and that's probably a massive chunk of the tax gap which they're getting told to focus on.
And I think an interesting point there is we're seeing, I think, increasing interest in HMRC and tax authorities more broadly around data gathering and the information that they can actually gather from other sources. We've seen this in the context of payments information and what they can then perhaps do with that data. And I think there's a recent development potentially in relation to electronic travel authorizations.
Yes, so as people may be aware, the Home Office is introducing, in effect, an ETA, a travel authorization system for when people, say, from Europe are coming to the UK. Now, traditionally, you can just come on your passport and you haven't necessarily needed a visa or anything like that, or any kind of pre-travel notification. That is changing for European nationals coming to the UK on a work trip or holiday or whatever from March this year. Obviously, when you look at some of the press, there's been lots of noise about the fact that UK nationals going to Europe are going to have similar obligations in reverse. But this is where foreign nationals, Europeans or whatever, coming to the UK, perhaps for a work trip, perhaps for a holiday, have to give that advance notification to HMRC. Now, that in some cases kind of raises additional interest from a kind of what I'd call a global mobility, international mobility perspective, in terms of it's potentially more data that HMRC can access in terms of, okay, which business travellers came to the UK? Were they being caught for social security compliance, or should they be caught for social security compliance or employment tax compliance? Could there be a greater chance, for example, perhaps they're creating a PE here from an establishment for corporate tax purposes if they're coming reasonably often? So we've certainly seen some of the Asian countries, for example, start to use, in effect, visa-type kind of, airport data, travel data, to try and understand whether business travellers are taxable in those locations. And I can easily see this being kind of a first step to HMRC having a similar process. On occasions, they have used data that they've got from the Home Office, but it's been very ad hoc. It's usually linked into a specific inquiry or something. Increasingly, once they get the kind of the data systems working properly, they'll probably try and do it much more proactively. Again, it's waiting and seeing to see how it finally works out, but I think it's something that companies should have on board and make sure that they've got systems and make sure they're compliant where they need to be.
I think that's a really good point, Robert, because we've certainly seen in the past increased data available to HMRC from an indirect tax perspective, certainly in terms of data provided by, for example, merchant acquirers available to HMRC. And sometimes HMRC do use those as part of their investigations. But I think what this is telling us is that going forward, tax authorities and HMRC are likely to catch up, becoming much more adept at using the data sources available to them. And so I think whilst perhaps we're not quite there at the moment, it is going to place a greater emphasis on taxpayers, I think, for in terms of truly understanding their data and getting ahead of the game in terms of what that data might be telling, what story that data might be telling HMRC.
Agreed. And it's the sort of thing where often companies just ignore it as much because they've got a lot on their plate as anything else. So it is potentially a black hole, at least for some companies. And like I say, I think if they don't kind of get ahead of the curve, they could be in for nasty surprise. Talking about nasty surprises, it's basically going back to NIC, one of my favourite topics, as people all know. And basically there was a case earlier this month, and I'll try and say the name correctly, but it's a Norwegian name, so it's going to be pronounced badly, I'm sure. But it's Odfjell Technology basically versus HMRC, which is basically, it was a kind of second tier, so upper tier tax case or an appeal by the company against an HMRC ruling in respect of employers' NIC. The fact that they were imposing an employer NIC liability and covering 10 years for this, and it could have even been 20 in extreme cases, but they were looking for 10 years, so between 2003-4 and 2014 in effect, on employer NIC, where you have in effect a UK entity, which is a client, but it's getting staff, etc., illegally provided by an offshore entity. So the offshore entity, this was basically in the Middle East for most of this period. So there's various kind of versions of the entity involved, but it's typically an offshore company providing the staff in the oil and gas industry, so basically in the North Sea. And it's a pretty hefty case in that there's 16.7 million of tax due, and there's going to be interest, etc. on top of that. The UK entity here was trying to argue that they weren't caught by these host employer provisions. And even if they were caught by the host employer provisions, they were trying to argue that where HMRC had imposed NIC, etc., in similar situations, and there was some other cases as well in this area, HMRC had only gone back 6 years, and therefore it was basically kind of against public policy or whatever to go back 10 years in this case, when other companies only had 6 years. But simple answer is they lost the appeal. The tribunal absolutely ruled with HMRC, which had won at the first tier in terms of saying, the tax, or not the tax, but the NIC was absolutely due. So I think it's basically an important thing in terms of reinforcing to people that even when you're not necessarily legally the employer of somebody, you can actually be, for NIC purposes or whatever, caught by this in a number of scenarios, whether you look at IR35 or in this case the host employer provisions. And HMRC is getting more and more aware of this issue. Employer NIC is obviously going to become a bigger and bigger issue going forward, given the increase in employer NIC rates which come in from April this year. Again, if you look at the fact that they're recruiting 5,000 staff, which they are scheduled to recruit over the next few years, a lot of those are going to be on compliance issues and audits and everything like that. And employment tax whether that's PAYE or NIC, actually it's over 50% of the tax take typically. They are major taxes, much more important than, for example, corporate tax. Realistically, of those 5,000 extra staff, I have to assume a very big chunk will be employed on payroll audits. So again, it's just a call for making sure, okay, what are your systems? Are you actually assessing this correctly? In this case, they'd actually received advice at the very start of the arrangement, but it seems to have been ignored basically, or at least in many cases, people have forgotten about it. They'd filed the memo or something like that, which said they have to be meeting ABC criteria, but then it had been ignored for 7, 8, 9 years. So again, even if the advice may have worked, and I think there's a chance it could have worked if they'd followed everything perfectly, clearly what happens in practice can be very, very different. So it's a call as much as anything to make sure you continually review, control, govern correctly what you're doing in any tax planning.
And from a sort of non-PAYE and NIC specialist perspective, the thing that leaps out at me is that time frame for the assessment of 10 years. Wow. That obviously racks up the liability hugely for the taxpayer, and a stark reminder that actually you really do need to pay attention to time limits and assessment periods, because they really vary quite widely from tax to tax.
People consistently get caught out by the time window, particularly for NIC, and the revenue are very keen on NIC because it's the sort of thing where, there's no credit relief. So you may find some of these individuals are paying NIC in another location or Social Security in another location. In many cases, that's irrelevant. You can have double Social Security liabilities, whereas with tax, it's very often that, if you're paying in one location, you're getting credit in the other location. It's just how you cut the cake. But with Social Security, it can, in a number of scenarios, be a genuine double charge. That's all we have time for this week. But Gabby, last week, Hannah and Melissa mentioned a recent case regarding the categorisation of sports drinks, and we've seen Jaffa Cakes kind of having a similar issue in the past. Is there anything that you'd like to mention in that regard?
It just brings that fabulous quotation by Lord Justice Sedley in Royal Sun Alliance to my mind, which I will quote now for the benefit of listeners. Beyond the everyday world lies the world of VAT, a kind of fiscal theme park in which factual and legal realities are suspended or inverted. And the world of VAT and food is, I think, absolutely prime example of that. The amount of time in various courts over the years arguing about the VAT liability of food items has been quite mind-blowing. But if I'm honest, I don't think there's going to be any change to that within the sort of short term. The reality is the zero rating for food is hugely contentious, and any significant change to that will create winners and losers. So from my perspective, I think it's unlikely to be an area of tax policy where we see any significant change from a legislative basis. So therefore, I really do expect the quibbling about the composition of various food items to very much continue in the future.
Oh, no, I thought we were going to have some more George Osborne's warm pasties or whatever and VAT on those, but hey-ho. Okay, thanks, Gabby.
The Tax Factor from Blick Rothenberg.
Just to mention, we have a new episode of our Success Stories video series available on our website and YouTube.
Each episode, we talk to one of our clients about their journey to success and their advice to other businesses and fellow entrepreneurs. The latest episode features Mark Levy, audit and accounting and outsourcing partner at Blick Rothenberg, talking to Dom Halls, the group CEO of Selby Anderson. They own a group of marketing agencies, and it's a fascinating story about how that industry is developing and adapting post-COVID. You can watch it on our website or on YouTube.
We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever it's most convenient. If you enjoyed the podcast, please subscribe and give us a rating or review. Next week, Nimesh Shah and Heather Self are presenting, and I have no doubt that HMRC will be a feature of their discussion. But for now, that's it from The Tax Factor. Thanks for listening. Have a good weekend.
Goodbye.
That's The Tax Factor. If you enjoyed The Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.